Welcome to this episode of Dividend Discussion. In this series, I really want to give every dividend investor a chance to tell their story. We're going to get to hear things like when and how they got started, mistakes made, lessons learned, and much, much more. My ultimate hope for this series is for the guest, you the viewer, and even myself to be able to take something away from this conversation to make us all better dividend investors. No matter if you're retired and living off of dividends or just got started yesterday, there's always something to share and even more to learn. So if you're interested in being on your very own episode, reach out to me via email at dividendobsession@gmail.com and I'll be in touch. But without further delay, let's get to the interview. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. My name is Troy and today I have the pleasure of speaking with Dick. Dick, go ahead and tell the people a little bit about yourself.
Hey, thanks for the invite. I look forward to this. Like you said, my name's Dick Yates. I'm 50 years old. I'm basically a general manager of a small manufacturing facility in southeast Kansas.
Well, there we go. That's short and sweet. I like that.
Yeah,
so,
there you go.
so you said you're 50, right?
Mm-hmm.
Okay,
Yeah.
so I'm going to say happy birthday, and that can either be early birthday or late birthday. You pick whichever one. It's going to be my new thing. I'm just going to tell people happy birthday. I'm never wrong. Okay, so first question for you is when did you begin investing? And then what got you into the dividend side of things specifically? Like, did you start with dividends? Did you wander into dividends like everybody seems to, or how'd that work?
No, and this is where you stop me if I get long-winded.
No, you are perfect. The floor is yours.
Yeah, I actually started investing. I was probably 18.
Wow.
I bought I met a guy that was a broker, and I bought a mutual fund from him, and then had family that worked at Walmart. So the first common stock, individual stock I bought was Walmart. Again, when I was probably 18, 19 years old.
Do you still have it?
Yeah. So I've been doing it a while. Made a lot of mistakes. Finally discovered dividend investing fit my personality, my style. It was something I was most comfortable with, and I find that when you're most comfortable with something, you're going to learn, the most about it, and you're less likely to do knee-jerk things that cost you a lot of money.
Yeah.
When you're comfortable with the method, and know what learn to know what you're doing.
Yeah, I can agree with that. It's so when you said you bought your first mutual fund at 18 and then Walmart at 18 or 19, do you still own either one of those?
No, I don't.
You kick yourself like for the Walmart one. I mean, I don't know what the mutual fund was, but like, do you think the Walmart one you'd be like, a bajillionaire by now or what?
No, probably not. I'd like to say that, but it's like a lot of people, they go, wow, if I would have bought Bitcoin
yeah.
at $1
Yeah.
a Bitcoin, I would have this, $60,000 Bitcoin. Just now you wouldn't have.
Yeah.
You probably wouldn't have hit 100. You would have sold it. Thought, damn.
Yeah.
$100.
Yeah.
So, no, I don't think so.
Okay. So when you were 18, so that's what, 32 years ago? I was told there could be no math. That's 32 years ago.
Yeah.
So, did you how long after, was it the purchase of Walmart that you started to get the dividends from that and got you thinking about it? Or was that many, many years later where you looked at all the different kinds of investing styles and then kind of narrowed it down?
It was later. The dividend side, that was just there was not a lot of thought put into that. Like I said, I had family that, Walmart. And Walmart stock had been, done well for a lot of people back then. So that's why I picked Walmart. And then, of course, I went through the .com craze and just slowly over. I've made mistakes. I've traded. I wouldn't say it's a mistake. I don't like it. I don't like trading. It's too stressful.
Yeah.
It's way too stressful.
Stressful, time consuming.
I don't want to be. What's that?
I said stressful and time consuming.
Yeah, I was going to say I don't want to be a slave. I don't want to sit here and feel like I have to sit and look at the screen all the time.
Yep.
And that's another thing I like about. I'm kind of a lazy investor. So
yeah.
I like to find good stocks that fit my style, and then buy them at a good. I'm a value investor more than anything.
Okay.
Um, and I like to buy them at a good price and hopefully never sell them. I will trim a little.
Okay.
If they run up too high and become too big of a percentage of my portfolio, I will trim. But I prefer to hold things for a long time.
That's pretty cool. So, okay, so you spoke about this already a little bit, and you were talking about some mistakes that you've made. What would you identify as your biggest dividend related mistake? And then, more importantly than the mistake, is what lesson did you learn from making that mistake?
Probably like everyone that gets into dividend investing, yield chasing.
Yep.
That's it. That's probably going after. Oh wow, well, a hot one right now. We're on the same Facebook group. It gets brought up all the time. MPW.
Mm-hmm.
Oh man, I don't even know what is that. 17%.
Yeah, yeah.
17%, man.
Well, I mean, Zim was the first one that did. Like, Zim was real big during COVID, and everybody was about that. Then it was the Yield Max funds, and now it's MPW, and before that, it was AT&T and Verizon, and all kinds of stuff.
So yeah, I've that like I say, like probably most everyone that dividend invested, it's probably the yield traps, chasing yield. It is probably the errors that I've made as far as dividend investing.
Okay, so this is a follow-up to that I don't know that I've asked that I think is actually a really good follow-up. So we, like you said, I feel like all of us that do dividend investing, we've all fallen for the yield trap. Do you remember the situation that caused you to realize like there's something more to this than the yield? Like what made you realize, hey, wait a minute, like I might be getting more and more in dividends because I'm putting in more and more money, but like I'm not actually like maybe the stock's losing more value than you're getting in dividends. Do you remember what that flip, the switch was flipped? Like, do you remember that situation?
Not the specific situation. I just remember over time, I just began to realize a lot, not all of them, but a lot of the yield, well, all of the yield traps, but a lot of the high dividend paying stuff was trash.
Yeah.
They were paying high yields for a reason.
So were you, and like this is a question I'm kind of like reflecting back on myself. Like, were you looking at it and then like trying to see like, hey, I'm getting a lot in dividends from this, but like the total return is negative, or
right.
the opportunity cost of investing into something else, even though the dividend's lower, but I would have made more money, kind of thing.
Right. Absolutely. Yeah.
Okay.
When you start to notice higher quality companies that maybe didn't pay, or they didn't pay as nearly as high a dividend, but they're much more solid companies, better quality companies, usually a lot better dividend growth.
Mm-hmm.
And that's a lot of my focus. I basically look for companies that are solid companies, really good balance sheets, very little debt, that they have the cash flow to cover the dividend that they pay, and they grow their dividend. That's pretty much kind of my wheelhouse that I look for, and I try to buy them at fair value or below. Like I say, I am a value investor. It's just fits my personality.
Yeah.
Better. I don't like to overpay for stuff.
Yeah.
Ever.
So do you have a lot of cash on hand right now, I guess?
I do.
I was going to say, because everybody thinks everything's overvalued now. So
I do.
So hopefully this is far enough into the interview that nobody will steal my idea. But I want it to do, actually, no, remind me of my idea. We'll talk about it after the show because I want to get your opinion on it. Okay, so we went over your biggest mistake and what you learned from it. So how you already spoke about this from starting with your mutual fund in Walmart into now being more of a value investor. But like, are there any other things that you can identify as like how you've changed as an investor over the last 32 years?
Oh yeah, way more patient.
Okay.
If I could go back and tell my 20-some-year-old self, that would be the thing. I would say be very patient. Don't be in a rush to. There will always be good companies to buy.
Yeah.
And be patient. Don't chase. That's been another one of my mistakes. I've which a lot of people probably do. I've fallen into the trap of FOMO, and I got to get on this. I got to get this. Look, my friends are making money on this. Nvidia.
Yeah, yeah.
You
I was
know,
just
right
gonna bring
now
that up. Yep.
I whatever works for you. But me, I wouldn't. Yeah, I wouldn't touch it because I'm so afraid. I would rather see. I'm able to sleep more at night if I missed out on say a Nvidia and I seen it go and higher, and I missed it. I got no problem with that. What I hate is waking up and going, man, I paid way too much for that, and now I'm in the hole.
Yeah.
You know, I messed up, and I do. I'm going to mess up. I'm going to make mistakes. Something I missed about a company, but I have also noticed that I can. Uh, I don't have to pay as much for the mistakes if I buy it at the right price.
So okay, so being a value invest, I mean, there's a bunch of questions I'm going to have on this. Hopefully, I remember all of them throughout the interview. But the first one being, when you are identifying a new position to buy, do you have like a strategy of like, hey, it has to hit this price, but if it's within 5% of that price, I'm going to put in a little bit to start my position. Like, how does that work for you?
Yeah, I might do that. It depends on if it's a really good quality company. Um, I will do that. I'll do it. I might put a small position on it, like at fair value. Once I determine the fair value, I might, if it's a good quality company, and I'll look at a chart too. I use technical analysis a little bit, very little, but I'll look at a chart like and say, okay, this company has never hardly goes below fair value.
Yeah, like Costco.
Yeah, yeah. So I might go, okay, I'm gonna put an alert on this company at fair value, where normally I might not want to buy, and I won't take a full position at fair value. But if I know it's a good company, solid company like Costco, and I'm gonna say, okay, I'm gonna set an alert at what I figure fair value to be, and then I might take a small position there, and that helps me keep track of it more.
Okay. Now, when you say at fair value, like, do you ever do your own research on what you determine to be fair value in, and then also like check for other people's interpretation of fair value to see if maybe you missed something or?
Yeah, I do. Yeah, I do. Free cash flow is my go-to, discounted free cash flow. I also like to look at, which they don't match a lot, but I look at Morningstar's fair values. Um, I kind of go off of them also.
So do you ever like not necessarily second guess yourself, but like go back and like double check if like a fair value that you determined was like either way higher or way lower than something else that you compared
Oh
to?
yeah, yeah, all the time, all the time. I go over. I've got a list of stocks, either that I own, and I always try to watch them, or I've kind of got an A list and a B list of stuff I'm watching,
Mm-hmm.
stuff I have alerts for, and I always go through, like, well, Apple, for example, it's recently uh, fallen a bit. So when I see stuff like that, I'll go, okay, let me make sure I'm not under or overvalued. Should I be buying Apple now?
Mm-hmm.
My alert's not going off, but this thing's, it's come off its high quite a bit. Maybe I missed something.
Is so do you think last year I feel like the whipping post of the stock market was SCHD, at least in our space, right? Like in the dividend
Mm-hmm.
space, everybody was poo pooing on SCHD. Now here we are at all time highs with SCHD because people don't have any patience. Do you think Apple is 2024's whipping post?
I
I mean,
hope
it's still
so.
early. We're in March for crying out
I
loud,
hope
but
so. I
yeah,
hope
because
so.
like the amount of articles and stuff I'm seeing that's like Apple's over, Apple's done, like
Yeah.
sell out. I'm like, what are we doing? Like literally 6 months ago, everybody was like Apple, Apple, Apple for all the good
Yeah.
things, and now it sucks. I'm like, what
That,
happened?
that would be awesome. I hope so, because that's when I'll be buying.
Do you
Um,
remember what it? So 2024 would be Apple, 23 would be SCHD. I mean, I guess Realty Income was in 2023 as well, because that's a REIT and interest rates went up and stuff like that. Do you remember like some of the other years, like 2022? I mean, 2022 2022 was the bad year, so I feel like everything was the
Yeah,
whipping post. And then
everything was.
2021, everything was great. So I think everything was the.
Yeah, I kicked myself in the butt for missing. I missed some. I wish I would have. It's hard though. It's hard. If you're a value investor and you're waiting for stuff to go below its intrinsic value, usually something's happened to push it down there, and it may just be the emotions of the market. Um, and so it takes some courage to go. I've looked at this and looked at it and looked at it, and everything looks good, and then to buy it.
Yeah.
When everybody hates it.
Yeah. Well, and that's
sometimes it catches you. Sometimes my risk that I accept is that sometimes I might fall for a value trap. A value trap's probably my risk. I try to avoid the risk of chasing a way overvalued name and losing money that way. I put my risk more on, hey, I might risk getting into a yield trap on this, but I think it's worth the risk. Plus, I'm going to get paid for it while I patiently wait.
So your risk being a value investor is more along the lines of like the saying of like trying to catch a falling knife kind of thing?
Yeah, for sure.
Okay, yeah. So, okay, and here's like these are all unscripted questions. These are just things I'm thinking of. So, when you have a time right like now where everybody's saying everything's overvalued and you build up your cash position, more than likely you probably don't have like just one stock you're watching that all of a sudden hits this magical number that you come up with as far as the intrinsic value. Yeah. More than likely it's probably multiple stocks hitting at the same time. How do you decide which one or ones to buy, how much you're putting in? Like, how do you determine what a full position and a partial position are? Like, how do you do all those things?
Well, like I said, I have a list of I have what I consider my A list of names that I want to own, and I have my target price and I have my alerts set to, because I'm not, like I said, I'm kind of lazy. I'm not a trader. I don't want to be locked to the screen. Mm-hmm. So I set alerts to tell me, hey, Apple is, hit your number. That doesn't mean I automatically buy it. I go back and I dig in again and go, okay, why is it down there? Well, why did it fall that low? Is there any real reason for this? And if I don't find, if I find that I don't think there's a change, a fundamental change in the company that's caused the price, if it's just a reaction by the market, then I'll take a position in it. As far as position size, that's where it becomes more of a. It just depends. It depends on how the value at the time. Like right now, for example, and I think it's this way in any market. There's sectors that are for a value investor that you can still find value, even though most things right now are overvalued, in my opinion. REITs, for example, right now, that's where I find myself being drawn to more. To me, REITs are where the value is right now.
A lot of people are saying like REITs and financials, right?
Yeah, financials. I'm a little leery of banks. I do own a few banks. I don't know how to value them as well as non-financials. I do own some. I like Canadian banks better than I do U.S. banks.
Mm-hmm. Some of those got like 200-year streaks of paying dividends.
Yeah, I think they're a little safer too. I think they're better regulated than we regulate our banks. But there's an old saying about investing in banks: is you buy them when their book value is below 1, you sell them when their book value is above 2, and I kind of use that. I use that. That's how I value bank. If its book values at 1 or below, I look just like looking at a value another value stock like we were talking about earlier. Why is it below 1? I will investigate that further. Why
Mhm.
is it below? Is it below one because it's about to go bankrupt? Or is it below one because people are just freaking out about something, but their balance sheet's good, everything looks good on it,
Mhm.
worth the risk, take the risk. There's a few banks that I bought one of them that I have that has done really well, and I'm actually watching it right now to possibly trim a little bit on is J.P. Morgan.
Mhm.
Uh, I think that's a really safe bank. That's the bank.
Well, yeah, I feel like at a certain point, like you have a margin of safety there, just because, like, you know how they say too big to fail kind of thing. Like
Yeah,
if J.P. Morgan goes under, like we got some bigger problems.
that's the way I look at it too. I'm like,
Yeah,
yeah, if J.P. Morgan goes under, then I'm not going to be worried about my portfolio. I
yeah,
probably need to start stocking up on canned food and ammo,
yeah, yeah,
because things
yeah,
are going to get
exactly.
pretty bad. But
Yeah, I like that. Yeah, yeah. Like I said, those were all just things I had random questions. So, like, let me give you a hypothetical. You have 10 grand saved up because market's overvalued. You have four stocks at the same time from your A list that meet your target price that you identified. You looked at why they met your target price. Everything's still squeaky clean there. How do you like? Do you pick a little bit in all four? Do you do 2,500 in each of them? Like, how do you do it?
I would probably not go full. I would probably hold half of that 10 grand in cash. I put the other half in each of those names, and then watch them very close to start uh, deploying the rest of that capital as the hopefully it went down.
Okay, so you would like average down because you like the idea of like you timing the bottom or something just because an alert you set's not high, right?
Yeah, absolutely. I mean,
Yeah.
I expect it to go down more.
Okay.
So I probably wouldn't, if like in your scenario, if I had 10 grand cash and there was four names that I really liked, I would probably first take 5 grand and split it among the four. Just if we're talking hypothetical,
Yeah.
this
Yeah.
is my style of doing it because I'm
Yeah.
sitting there going, most likely that they're going to go down more,
Okay.
and I kind of hope they do,
Yeah.
and I'll add to it.
Okay.
I
All right.
don't just I don't just add to them though when they go down. If they're below fair value, I'll kind of dollar cost average into stuff. That's what I've been doing with some REITs. I've got some what I consider some pretty quality REITs that uh, I kind of dollar cost average into right now.
Okay.
And it's slowly because of that, because that's where I'm finding value right now. That's slowly also becoming a larger as far as sectors go.
I was just gonna ask, like, if there's a long period of time, like there has been, like what over the last 12 to 18 months, where REITs have been kind of beaten up. Like,
Yeah,
what happens when real estate becomes 30% of your portfolio? Like, do you have to pump the brakes and say, I know these are still undervalued, but like now it's too
yeah,
overweighted?
yeah. I watched that. I watched that. So right now, that's happened to me. REITs weren't that big a percentage of my portfolio until the rates started getting pumped and REITs started going down, and I was like, well, I've been watching these for a while and wanted them, and now I'm gonna get them.
Yeah.
And so I've just like we said, I put initial positions in, and I've DCA'd in just a little here, a little there, over time,
Yeah.
and slowly. So I'm looking over here because that's where uh, my portfolio diversification REITs has actually become one of the top sectors that I have.
What percentage are you in REITs? Do you want?
It's about 17%.
Okay. Yeah, I don't know. So I mean, we'll get into diversification a little bit later in the interview, but like I don't know that I super subscribe because like the idea that you're only supposed to have more no what do they say, no more than 5% of any one holding. You're not supposed to have more than 20% in any one sector. Like
Right.
that's also very dependent on the number of positions you have. I have 11 positions in my portfolio. It's quite literally mathematically impossible for me to have under 5%. Like I can't,
Right.
like 5% times 12 does not equal 100. So like I'm
Right.
kind of screwed. So I don't know. I don't know that I subscribe to that. I do subscribe to some level of diversification, but I do also believe that there's such a thing as over diversification. So,
I agree. I
yeah.
agree.
So
And same thing on this. If I'd be fine with the real estate side of it growing more because, like I said, I know right now that's what I'm buying uh, because that's where I find value.
mhm.
Um,
Yeah.
And I think it kind of naturally balances out. Eventually, REITs are going to go. They're going to become overvalued, and I'm going to quit buying them. And something else is going to fall out of favor. Maybe it's consumer staple. Maybe it's energy.
Hopefully
And
it's
also,
tech.
yeah, I
That'd be
hope.
nice. Yeah.
Yeah, I hope.
Yeah.
Yeah.
Okay. So so now we have a short message from our sponsor. Just kidding. I don't have a sponsor. I want to know, speaking of short, do you have any short-term goals from your dividend portfolio? Like, let's just say in 2024, and then like, what are some of your longer-term goals for the portfolio? Like in the next 10 years, what do you hope to accomplish?
Um, my long term goal with them is to my kids get them when I die. I mean, I don't ever want to sell them.
Do you want to retire off of the portfolio at all, or do you just want to keep, you like what you're doing enough to like keep doing it and stacking away?
I'd like to eventually. What I would like to do is, retire. I don't really want to sell any of the stock. I'd like to just retire off the dividends, and if I'm lucky, who knows, life is life and things change. But if I'm lucky, I won't have to sell any of them, and my kids will be happy with me when I
Yeah.
kick the bucket, and
Yeah.
and they can do whatever they want with it.
Yeah. Well, so I mean, you mentioned that you're at your son's house and you're doing he has this whole streaming thing.
Yeah.
Is he your only kid?
No, I have three.
Are any of them interested in investing, or are they just like everybody else that you talk about it? They're just like, whatever, dad, like leave me alone.
Yeah, not really. Not really.
Yeah.
We're no. It's like everyone else. Like I said, that's why when you invited me here, I'm like, that's awesome. I don't know about the whole YouTube thing, but if it's an opportunity to talk to another investor,
Yeah.
You don't run into them on the street very often.
The amount of like spam messages I get like on Facebook, YouTube, wherever, where it's always coming from like somebody trading crypto, somebody trading Forex, all kinds of stuff. I'm like, nobody's ever reached out to scam me about a dividend stock. Like, isn't that nice? Like, nobody's ever like, hey, have you heard about 3M? I'm like, nobody ever does that. Like, it's always
maybe I need to do that.
Yeah, yeah. There you go. Just start. That's a whole untapped market, is what that is. There you go. So do you have any short-term goals this year that you're trying? Like, is there a certain patty that you're trying to hit or something like that?
No, not really.
You're just kind of going with the flow, adding positions.
Yeah, like I say, I say I'm a lazy investor, and I kind of joke about that because I do like it. Like I said, I look at investing like a lot of people would follow fantasy sports.
Yeah,
I will just read and read. If something interests me. Like the other day, I was trying to figure out another sector that a lot of people are saying, hey, it's undervalued. It's undervalued is utilities.
Okay.
I'm not a big utility fan.
Yeah.
So, but I'm like, what am I missing? What am I missing? So I've been reading a lot about that, trying to convince myself, and I haven't yet.
Hey, if you're trying to convince somebody, convince me that you like NextEra Energy. That's what I want you to do.
Yeah.
That's my biggest dog. And like, I bought it and like, it's a dividend king. Like, it does all the same things. Like, I understand they have debt, but they're using their debt like because they need to. They're doing acquisitions, stuff like that. Like, they grow their dividend at a double-digit pace year over year. I'm like, they meet all the things I like. They're just getting destroyed. And I'm like, can you stop? Like, can you not do that?
You're not alone. It's funny you mentioned. I own it too.
Yeah.
And that's the one I went through, and I was like, okay, utilities. They're undervalued. The only one I found that I liked is that one.
Well, good. That's good enough for me. Yeah.
But I'm the same way you are. I'm like, I haven't bought any more of it. I'm trying to convince myself to. I haven't been able to pull the trigger.
Yeah. Yeah, I've been trying to average down on it all the time. And like anytime I get, so that's my thing. So I don't do value investing. Also, we're at different points in our investing journey. Like, I'm 29, like I have a bunch of years left. And my philosophy, and like in the groups that we're in, I hear so many stories of people that they set this number for this stock that they want, say at Apple, Microsoft, Visa, some of the stuff like that. And then because it never hit this number that they pulled out of somewhere, they never get to own these. And to your point, there's plenty of quality companies out there. Like there's always another opportunity. But I'm just like, man, imagine like 20 years ago waiting for Apple to hit $36 and it went down to $36.50 and you're like, I'm not doing it. I said 36. And I'm like, you missed out on all those gains because you wanted 50 cents.
100%. Yeah. No, you're right. Time frame makes a huge difference. Your time frame and my time frame are different.
Yeah.
I would be more towards your side of doing things if I was 29.
Yeah. And mine's literally like I put a certain the wife and I have 2,000 that we put into investing for the month, but we split that between our Roths, both her Roth and my Roth, and then our taxable account. And I literally have my active. So this is a new thing, my active positions and my dormant positions. My dormant positions are ones that don't meet all my current criteria, and my active ones do. So my active ones, I just literally divide by the percentage I want those to equal versus what they currently equal, and divide it by the number of trading days in the month. And I put that, and literally it's 456, 516. Like, it's little dollar amounts, but it's every day. That way I don't have to worry about the emotions of the market. If the market's up 6%, down 6%, if it's flat, it doesn't matter to me. I just buy every day. I get the average of all of it. So, and that's my thing. I've been doing that with Next Era Energy for a hot minute, and it's still negative. So that's how I tied that in. But hopefully, it comes back. My cost basis keeps going down. So.
I think it will.
Yeah.
The nice thing about it is, if it's any comfort or consolation, you're getting paid a little bit.
Yeah.
And they raise their dividend. But that's the way I look. That's what I like about dividend investing too. I'm like, okay, I'm gonna take a shot at this, and if I'm wrong right now, it's still a good company, and I'm reinvesting my dividends, and I'm getting paid to be patient. They're paying me, every quarter or monthly if it's something like realty income, and I'll just be patient. And if it's a good name, usually I've seen it myself. Things turn around, and I think it'll head back up.
Yeah, and as far as like Next Era Energy is concerned, I think their last earnings call, they already announced that they're going to probably they are looking towards doing a 10% dividend raise over the next, like, this year, next year, and 26. So that's one of my big requirements is the dividend growth rate. So I'll take a 20% raise over 2 years. So I mean, technically it's more than that because it's 10%. It's compounding 10%. Yeah. So hopefully that gets me back. I mean, I have 11 positions. I think 2 or 3 of them. I think it's 2. 2 of them are in the negative. Everything else is in the green.
So are you just invest in individual stocks, or do you do like ETFs?
My brokerage account, like the one I track the most on the channel, is 11 individual stocks. My taxable account, that's the one I'm going to use to retire early because it's taxable. It's already taxed, kind of thing. And my Roth IRA is all ETFs except for Tesla. So I have 6 ETFs and Tesla in there.
So you don't just invest in dividend stocks?
Well, yeah, I mean, Tesla's the only non-paying dividend stock I have in my portfolio. Honestly, like, hindsight, I really like Tesla as a company. I think Elon Musk is a genius, like all kinds of stuff like that. I really like Teslas as cars. I've driven them like 6 or 7 times. It'll be my next vehicle whenever mine blows up. But hindsight 2020, I wish I would have bought NVIDIA instead of Tesla in there because obviously. But actually, Tesla might be the 2024 whip and pull, actually. Because that thing's getting killed this year. It's like down like 40%.
Could be.
Yeah. So Tesla and Apple. Look, what kind of world are we in where Tesla and Apple are getting kicked?
Yeah.
Like, what?
Maybe I need to look at Tesla.
Yeah, there you go.
I don't just stick with dividend stocks either.
Yeah, Tesla's. Right now, I think the last time I looked, like I said, I don't really care about stock price too much. I think the last time I looked, Tesla was under 180.
Really?
Yeah. Which is, I mean, honestly, to me, here's the deepest my knowledge goes. Are there going to be EVs in the future? I would say there are. Who is the leader in this space?
Sure.
Tesla. Is there anybody else that could reasonably catch the infrastructure and the competitive advantage that Tesla has? Brand recognition, the cult-like followership of their CEO, like the fact that they've been doing EVs since 2012. They have so much research, so much knowledge on the situation. Other EV car makers, your Fords and stuff like that, are either suspending their operations from making EVs or they're coming over to Tesla's superchargers. Why? Because Tesla has such a big market share of the whole situation. Therefore, if you believe that this thing is going to be a thing, whether it's for you or not, whether you think it's going to be a thing, who else would you rather own?
Yeah, that's a compelling
Yeah,
argument.
that's my soapbox. So I'm gonna step down
Yeah,
for this. So I mean, it's
yeah,
just one of the things. Like, okay, Tesla's down. Like, yeah, whatever. One, I'm still up on Tesla, and two, like, I don't think EVs are going anywhere. Like, it is like the future is EVs. It might be more hybrid than full EV. I don't know, but like also, if you do want to go ice like combustion engine, hybrid, or EV, Tesla's your thing in the far right corner. So I don't know.
yeah. I've recently been looking at taking a position in some lithium
Yeah,
companies.
yeah.
So
When and
because
that's
of
the
that,
thing too
because of
is
basically what you just said.
yeah. When and the thing about that is like Tesla is trying to, and again, this is like surface level understanding of what I know about this. Like Tesla is doing so much to bring everything that they can within the EV space in house. They're making their own battery cells. They're trying to get
Yeah,
their own mines. They're trying to do all kinds of stuff to where they don't need to send any money out to get this stuff. They just do it all themselves, which is like they're just building and building and building to their own brand. I'm like, why would you not?
right.
So,
Right.
okay, so you probably asking a value investor this is probably like one of the best things. So, do you have any stocks that you like selling regrets / buying brags? So therefore, like something you identified super low fair value or super low value went down to there, you bought it and it skyrocketed for you, and or the flip side where because you said you do trim. So if you had anything where you're like, hey, this is identifying a good spot to trim, I trimmed it and it just never stops going up. Like I should have probably kept some of that.
Well, one that's done pretty well for me recently, um, Phillips 66.
Okay.
I, I've trimmed it recently. I bought it, if I remember right, I'm going off of memory. It seemed like I sometimes you get lucky and buy them right at the bottom.
Yeah.
Rarely. That's one of them. I hit. It seemed like I bought it and it just did nothing but churn up. And I added on some dips, and finally I've decided to trim that a little bit. Just because it's nothing I'm in love with. They're not growing their dividend very much, but and energy, it can be cyclical. You can get it can have pretty good swings. So I trim that.
Do you have any
Snap
trims that
on.
you've done that you regret trimming?
No, I try not to, because I always I figure it's good to, if I can profit and put some cash in my pocket, I try not to regret that.
Yeah,
I'm like,
yeah, yeah. And then okay, so
my
that's
regrets are more on the losing side. If I lose money, if
okay.
I make money, I don't regret that.
So you still have positions like that where you identified those as good buys, good opportunities to buy, and like you said before with the catching a falling knife, like sometimes it just keeps going, and like you still have those being a value investor too.
Yeah,
Okay. Because it sounds
yeah.
like that's kind of like the pro to it. It's like, hey, man, I identified this thing. It's already like as low as it could go. I'm just going to buy it and we're going to go up from here. But I'm like, that's not really how those things work.
No, I want, like I said earlier, when I buy, I won't go all in, and go, oh, because I know I can't pick the bottom. If I could pick the bottom,
You'd be done already.
I wouldn't be talking to you.
yeah, yeah,
I'd be on an island somewhere.
yeah, yeah.
But no, there's a few of them that I've hit pretty well. Recently, I've had this one a while, but it's been in my view overvalued until recently, that I hadn't bought any for a while, and I really like. It's one of the REITs I like. I like American Tower.
Mm-hmm. That's
I like
AMT, right?
Yeah, AMT. I
Yeah.
like AMT, and I don't know. Well, it may go back down, but it recently, I can't remember. It's been a couple months ago. It hit its bottom. Uh, I'm talking back like in the last 5 years. It's
Mm-hmm.
finally come down to a level where I was like really happy when my phone went off and I had an alert on it, and it's like I had to double check it. I was like, "There's no way I just got an alert on AMT. I haven't had that go off in ever."
Yeah. That's
So
cool.
I started buying it again, and I kind of hit it right at the bottom and of the recent pullback, and that's one I like. It grows its dividend at like what 10%.
That's not really that common with the real estate sector either.
Yeah.
Because like
Yeah.
a lot of real
Right.
estate stocks have like higher yields is what I've noticed in like my research and stuff, but they all have like, shorter, typically underperformance or, close to in line with the S&P 500, higher yields, lower dividend growth rates is what I've
Right.
noticed, like my trends.
Right. And I know another REIT that people seem to love or hate is O.
Yeah.
I at this price I kind of like O.
I just personally, I don't own, I don't own any real estate individually. Like I don't own any in my taxable account. I own VNQ in my Roth IRA, so that's my exposure to real estate there. And then I own a house. That's my exposure to real
There
estate.
you go. Yeah.
But for me, I feel like so many people are just so, like, I don't want to say blinded, but I'm going to say blinded about realty income because it pays monthly and, because they raise their dividend every quarter. Quite like I've mentioned this in several other interviews, quite literally, you cannot find a denomination of a coin by how much they raise their dividend by quarterly because it's half of a penny or a quarter of a penny. Where do you find quarter of a, like, so it's one of those things where like a lot of people don't know this. Tootsie Roll is a dividend king. I will encourage you not to look up Tootsie Roll's stock chart because it's awful. But what do? They find the smallest amount of money that they can raise their dividend by yearly because there are ETFs that track the dividend kings. So they're getting some of that. They're getting some of that investment, which is just capital infused into their business, like kind of thing. So it's one of the things. I have a couple people that are subscribers of the channel that'll ask about the dividend kings and aristocrats. I'm like, yeah, it is a good list to start from. I think we all, like, somebody starts from there all the time, but like, it's not this is a dividend king, it's got to be a winner. That's not how that works. So it is worth doing your own research. And I feel like realty income's that way too. A lot of people, especially I see people that are like 19 investing into REITs and stuff like that. And I'm like, guys, like there's so much more to this. You're leaving so much meat on the bone by taking your dividend today, 37 years before you even think about needing the income. I'm like, there's way bigger fish to fry, in my opinion.
Oh, I agree with you. And again, it depends on your time frame. I think the closer you get to, my age, or when you're thinking you're going to start not reinvesting the dividends and start using them to live on, then maybe you start looking at, the dividend.
Yeah.
As opposed to the dividend growth. But if I was your age, it'd be all about dividend growth.
Yeah. My portfolio average right now is 11%.
Nice.
So that's kind of my thing, is like, I like nice. When I just switched from my Power 5 series to my Top 5 series on Fridays. I released that. And the ones I'm picking, like, it's a lot of, like, it's stuff that I like. And there's like the one that I just mentioned at the time of recording, it was this past Friday, yesterday. And like, there's some in there that I don't think anybody's ever heard of. f.i.r.e Management. Have you ever heard of that one?
Yeah, I've heard of it. I don't know a lot about it.
So they outperform the S&P 500. They have a dividend streak over, I think it's 6 years, 5 years, 6 years, something like that. Dividend growth rate north of 14% for the 3 and 5 year. It's f.i.r.e is the ticker for that.
f.i.r.e.
Yep.
Okay.
And it's, like, obviously do your own stuff and you'll set your prices and stuff if that one looks interesting to you. But like, it's I think it, like, from what I saw, like I said, I don't dive super deep into a lot of stuff like everybody else does, but like, I seem to pick a lot of the stocks that everybody else that does dive super deep into. I pick the same stuff they're picking. So like, that's the saying, and cover the kitty's ears in there. There's more than one way to skin a cat, kind of thing. But like, it's one of those things where like, there's so many ways where you can identify good stocks. It's just about determining that for yourself and like figuring it out and sticking to it.
That's right. That's huge. What meshes with your personality, your psychology? I think that's huge. Once you find that, you're going to be less likely to get hurt by chasing because of FOMO or even you. In my case, like I said, I understand my risk is more. I got to watch out not to get into yield traps.
Yeah. Yeah, and so it's like, I don't know, if you just follow some YouTuber, me included, like if you just follow me and you're just like, oh, I like Troy's strategy, I'm just going to do that. Like, I don't, it's not necessarily that you need to come up with your own strategy, but you do need to, if you do use somebody else's strategy like mine, you do need to understand what the strategy is for, how to follow it, why those things are important, all those things. Because, like you said, when times get turbulent or something goes wrong, you need to be able to step back and be like, is my strategy still sound? Do I need to change something about my strategy? Am I only changing something about my strategy because I missed one stock? Or like, if you're everybody's gonna miss a stock. Like
Yep.
it just
Yep.
happens. Like you're not gonna catch them all. This ain't Pokemon. Like it's not how that works. So
Right. No, that's 100% right. The more confident you are in uh, your strategy, your methods, the less likely you're going to freak out, and sell at a huge loss. When if you're confident and you know what you have, and you're like, hey, instead of selling, man, I'm glad it's so low. I'm going to buy more.
mm-hmm. Yeah, I use the analogy hundreds of times. Well, I've only done like 33 interviews, but hundreds of times in these interviews, like if you go to Walmart and you're going to buy a flat screen TV and you're like, man, I really want that one. It's an 80-inch OLED, whatever all the letters are now. And you want to buy that and it's like, oh, it's $1,000. And you're like, oh crap, I forgot my wallet. I have to go home. If you come back to Walmart and that thing's now $800, you're not going to be like, wait a minute. Like you're going to be like, hey, heck yeah, I get $200 off. Like that's cool. Everybody in the stock market thinks the opposite.
Yeah.
And what I always wonder is like, are you really sure about what you're buying? If you don't get that excited when it drops, like for me, Apple dropped, Costco just missed earnings for the first time in forever. And everybody, it dropped 6 or 7%. I'm like, I'll take it. Thanks. Like, give me, I was going to buy it anyway. I don't care if it's 6% cheaper. Like,
yeah, that's when I think you really know you're comfortable. When I'm the same way. I know it sounds silly. I'm not going to say I try not to get into it too much. Sure, you pull up a screen and it's all green and it's hard not to like that. Mm-hmm. But I'm not planning on selling them. Like I said, I'll trim, but I try not to let that emotion like, oh man, I'm a genius. It's mm-hmm. green. I'm more of the thing. If I buy something and it goes down, I like it. I'm like, oh wow, nice. I'm going to get more of this. I liked it at 50. Now it's 45.
Yeah.
I hope I have some cash to get it.
Yeah. I think it's such a big thing. It's like the emotions of the stock market and stuff like that. I've talked about that hundreds of times already. I'm just like, yeah, like if you can figure that part out, you win 50% of the game already. Like regardless of what you pick, like quite literally, a lot of times people will pick good stocks and they have bad strategies and it messes it up. People can pick bad stocks and because they have good strategies, they can do well. So it's one of those things where if you can nail down at least half of it, you're already ahead of the game. And if you can nail down the other half, you're there. You win. Like it's just at that point, it's patience and discipline, and obviously capital. But
absolutely, patience and discipline. Knowing what you own, knowing your strategy, being comfortable with it, but not just being yanked around by some talking head, whether it's on you. I listen very, very minimally on purpose to CNBC.
Yeah. Well, that's a really, so I don't, like you said, you don't do like swing trades and stuff like that, and neither do I. Yeah. I feel like that's a great strategy, is if you do swing trades, just watch what they talk about on CNBC. You'll see, because it drives the emotion of the market. Everyone, oh my God, did you see that feature on CNBC? They were talking to the CEO and he said a word wrong. We're gonna drop his stock by 6%. I'm like, what are we doing? Like,
I messed with that. I did some swing trading and like I said, just didn't fit I found out it didn't really fit my emotion.
I mean, maybe when you retire, you could take a little, 2% of your portfolio and just have some fun. Maybe that's your thing. You enjoy stock market anyway. You might as well.
Yeah, I enjoy like the hunt, so to speak. I just enjoy the hunt. I enjoy trying to find things, and I don't just stick to dividends. This is the majority of it. That fits me well. But like lately, I've been really digging into, and if they pay a dividend, that's a bonus. But I've been digging into small caps. I'm like, seeing if I can find some value in small caps. And I'll go through hundreds of names. And I try to do it quick. I've got a method to where I can just, okay, that's no, that doesn't meet what I'm looking for. And I kick them out. But then I try to whittle it down, to, okay, here's 10 names that pass the quick criteria. And now I can do more work.
Yeah.
Try to find
Yeah, I mean, so that's so actually we'll touch on that here in a second. That's a question I have for you. So, do you have the next question is do you have any specific like dividend achievements or milestones that you remember crossing or achieving? And like do you remember the role that they played in help keeping you motivated? Because like you said, this is a long game. Like you need it, like I give the analogy all the time of like when you have a ladder, you have a 6-foot ladder, there isn't just the floor and then the top of the ladder. That's not how it works. That's not a reasonable thing. In order to make that ladder useful, there's steps every 12 inches to get you to the top. So it's just like that with dividend investing. Like, do you have any of those? Hey, I remember when I hit my first $100 a month in dividends, and like that was really good motivation for me, 20 years ago to keep me going. Or do you have any of those?
Yeah, that's always a big one. The overall dividend income, seeing that grow is definitely a motivator.
Yeah.
And then, don't put a lot of stock in it, no pun intended. But if you look at the income forecast,
Yeah. Your patty,
over years, huh?
the patty.
Yeah. If you look at the forecast from where you're invested now, and like what's it going to be 5 years from now, 10 years, that's a big motivator for me. I'm like, yeah, it should be close to that.
One thing I want to start doing with that I don't do. I mean, I have so much data. I feel like I have most of it I don't even remember that I took. It would be cool to like take a picture at the beginning of January every year of like your 1, 3, 5, and 10-year projections and where you think they are. And then like have some kind of alert pop up, whether it's an email that comes to you from yourself like 10 years later and be like, hey, 10 years ago, this was your projection. Like, did you beat it? Like, are you under it? Like,
true.
That'd be kind of cool. Cause like right now we see like for me, I have the projected annual dividend income to the right of my portfolio. And I can see, okay, in the next rolling 12 months, based off of no capital added, no dividends reinvested, and no dividend growth rate, this is what I'm supposed to make. But there's that, all those things are going to happen. All those no's that I just said they're going to happen. So like, it'd be cool. I do that right now where like at the end of every year, I take a screenshot of what that said, and then I just move it down on the spreadsheet. And then I have the one that is current above it. So I can be like, oh, okay, 2023, I ended the year with $918 in projected annual dividend income. Right now I'm sitting at 973 and we're in March. Like, it's just cool to keep track of that stuff.
Yeah, I agree. That's a motivator for me. I like to look at that.
Yeah. Even though it's always wrong, but it's at least guiding you in the right direction.
Right. I mean, every one of my stocks that I own, I reinvest the dividends. So
okay,
that's
interesting that you say that, because I know a lot of value investors that don't do that because they like to get the money deposited into their account and then they can look for better opportunities, because like there's a chance that something that you own is now what you would consider to be overvalued. Now you're putting money into what you consider to be overvalued, even if it's not your money technically, kind of thing.
That's true.
Yeah,
I've thought about that. It's just
you said you're a lazy investor. You just let it let it do its thing.
Plus, I'm like, well, I might be wrong.
Yeah.
In this way, I'm still investing in it, and if it keeps going, that's fine. But yeah, I reinvest all the dividends.
Hey, I just thought of a really good video idea. I'm going to do a video on dividend reinvestment, and it's going to be called The Hedge Against Ignorance.
Yeah, there you go.
That's good, because you don't know what you don't know. Like everybody, you think the stock's undervalued, then the CEO decides to share some information with you. You're like, well, that changes everything.
And then I'll feel good about, well, hey, I kept investing.
Yeah, there you go. Yeah.
I may not consciously,
Yeah. Hey, if you're rich, it doesn't matter if you did it on purpose.
Yeah.
Like,
but I was going to say, I don't take any of the dividends. They all get reinvested, but still another motivator. I like to look at the monthly, monthly income and go, yeah, that's pretty good.
Yeah. Do you look back and be like, oh, I could pay the mortgage this month with that?
Yeah, that's a good motivator.
Yeah.
I'm like, I could do this. That's cool.
Yeah.
I didn't do anything really, and I got this much money.
Yeah. That's the cool thing so I just got the YouTube channel monetized like at the beginning of the year.
Awesome.
And I know a lot of people will be like, oh, okay, like I'll make 30 cents a day or something. But to me, I get it. I'm a dividend investor. I get excited when I make, $6 from Apple, once a quarter. And I'm like, you're telling me I get 30 cents a day? I'm like, I'm in. Like, that's a good dividend right there. So, But yeah, technically I haven't gotten any of it because YouTube has this thing where they have like you don't get any money until you get like it's $100 increments, and I haven't hit $100 yet, so I haven't
Oh,
technically
really?
gotten anything. But they show me I have money in there allegedly. So,
Cool.
okay, so okay, here's a thing I have for you, and you being where you are in your journey, I'm curious your answer. So how or when will you know when enough dividend income is enough?
That's a good question.
There you go.
I
Like if you
don't
get up to
know.
100 grand a year, is that enough to quit your job and just do, whatever you
Uh,
want?
yeah, probably.
Is 80
Yeah,
grand enough?
yeah, probably.
But see, the challenge with it is because you have spreadsheets and access to information and you know how compounding works. If you stop next year at 80 grand, next year it's going to be 92 if you wait one more year. But then if you wait one more year, it's 108. And you're like, well,
That
son of, I'm never going to stop. Like,
that's why that's my thing. That's why I kind of hesitated when you said that. I'm like, I have to keep myself sometimes from investing.
yeah,
Not that I don't mean to say that I just go out and buy stuff. What I mean is I'm like, I don't know. I don't know if I'll stop because what you just said, I feel like it's like, why would I do that?
yeah, that's
Uh,
sabotage. Like, I can
yeah,
just,
why would I do that?
yeah,
It's like, I try to balance life and my error is on the side of I'm kind of a pessimistic. Maybe that goes with value investing. I'm kind of a pessimistic guy, so I'm always worried about what's the next risk, what's going to happen,
yeah,
what could. I want to be ready too. That's why I hold. Lately, I've held cash. I want to be ready for the next, and it'll happen. It
yeah.
always does, uh, but
So you don't
I
have a
try to
magic
tell
number?
myself, hey, I'm going to this is what I'm going to put aside for investing, but I still have to have, I'm married and it's like,
We still got to
we
do
might
some
like,
stuff, you know?
yeah,
Yeah.
exactly. It's like, I like it so much. So that's kind of also my hobby. So it's like, I don't mind not going to the beach if I can, you know,
If I can average down on next era energy.
if Pepsi goes down and I can buy more Pepsi
Yeah.
or, so I have to really watch myself. It's like, all right, come on, man, you have to live a little.
Yeah.
So I have to go take some of that money and go to Hawaii or
Yeah.
something.
I have to do. Oh man, I gotta go to I gotta go on vacation. That sucks.
Yeah.
Yeah. I'm in that same boat, man. It's like once you get to the point where it's a fun, like ups and downs of the market's fun.
Yeah.
Making money passively is fun. Talking
Yeah.
about dividends with other people is fun. Like I feel like that's the sweet spot to be in. Like it's not a chore. I'm not investing
Oh,
because somebody told me I need to do it to be rich. Like
no.
you just do
Like I
it.
said, it's my fantasy sports basically.
Yeah.
I keep track of it like guys keep track of, who they're going to draft.
Yeah.
I'm paying attention to
Yeah. Some
stuff like
people draft Giannis Antetokounmpo and some people draft Pepsi. It's just different. Like we just
that. Yeah.
do whatever. So
Yeah.
okay, so we touched on this a little bit, but here's where you can get into like the specifics if you wish. What are the specific criteria that you use? Like, do you have like a bullet list that each of your stocks must meet to get on your buy radar and actually pull the trigger to actually purchase?
Uh, Kind of off the top of my head, um, I like I said, I like cash flow is big to me. I'm a big cash flow guy. I like to see that cash flow doesn't lie as much as you can manipulate earnings and
Mm-hmm.
profit. And cash flow to me is the most sound criteria to look at. So I like to make sure they're growing their free cash flow. Their cash flow is going to cover the dividend. Um, Debt, I like the debt to be low. Uh, Debt to capital is what I look at a lot. Growing dividend, I
Mm-hmm.
like to see a growing dividend. Um,
Do you have like a length of time that you like the dividend to grow by, or do you have like a percentage that you like them to increase by, or just growing in general?
I like it. I like them to grow, and I like the higher the growth rate, the better.
Okay.
It's not a game. I mean, I buy stocks that don't grow very much, but I try to balance it overall the portfolio so I have a decent growth rate.
Yeah.
And then I might have some stocks that are higher yielding with very little growth rate. So overall, between the high yielders and the high growers, I keep both at a decent level. But I like to look at return on equity. That's like a quick one I'll glance at. Return on equity, return on invested capital. I like to see high operating margins, free cash flow margins. Those are quick glances that I look at. And so if I look at a company and the return on equity is in the tank or below what I want it to be, their margins are instead of growing, their margins are shrinking. That's probably going to be like, oh, okay, yeah, next. Another thing I like to see is them buying back shares.
Yeah. Well, so I'm hearing a lot about that recently, where people, and it's not like a thing that goes away. It's just kind of like the prestige of the company that's doing this, where people are really into stock splits, and they think it makes the company significantly different. And I'm just like, you're getting diluted to buy 4 quarters. Like it's quite literally, do you want 4 quarters to make up a dollar, or do you just want a dollar?
Yeah.
Like that's what's happening. And what happens is when you do 4 quarters, they might give you, two dimes and 4 pennies, because it is diluting the shareholder a little bit instead of a quarter. So I know that's a thing where people don't seem to value that. And and there's
I value that a great deal. I like to see companies buy back shares.
So that's interesting, because I know in my experience talking with a couple value investors, some of them don't like, not that they like companies diluting their company, but some of them are more skeptical of share buybacks because of being a value investor. It seems like a lot of them tend to buy back their own shares when they're very expensive.
Yeah, that's it. You want companies that are managed by people that know that and are good capital allocators. So that buy their share. Hopefully, they're not just buying shares back robotically, and they are trying to buy them back at good valuation.
Didn't Meta just do that when they announced their dividend? They also announced that they're doing a buyback. I'm like, why didn't they do a buyback 2 years ago when they were?
Yeah, that would have been the time to buy shares.
Yeah, like why?
Yeah.
I don't. So many people just like, they have like certain buzzwords that like they hear in their head and they're like, oh, that's a good thing. I'm like, that's not always a thing. That's not always how that works. Like for example, like years and years, it was AT&T and those guys raising their dividend, and I'm just like, this will not happen for much. It can't happen. MPW right now. They're just they're continuing to do it. And I'm like, yeah, that's great for now, but all they're doing is they're digging themselves a deeper hole. Like eventually it's got to stop.
Right. That's the thing. I know it's just the nature of the beast. That's my only, but I have to force myself to know that, different sectors need to be treated in different ways. And my one of my things I don't like about REITs is they just naturally they do dilute. That's how they raise capital.
Mm-hmm.
One of the ways they raise capital is they issue more shares. And that's a thing I have to overcome when I invest in REITs, is to overlook the fact that they do issue more shares. You don't ever see a REIT that buys back its. I was going to look at American Tower though, because I think that might be the exception.
Do you own any ABR?
I must not, because it doesn't ring a bell. No.
Arbor Realty Trust?
Oh no.
So no, that one, like I said, I don't have any REITs myself, but every time I do like my filters, when I would like filter for stocks that outperform the market, it typically, gets rid of higher yielding stocks. ABR is the one that always sneaks through. It outperforms the market, has a dividend streak of over 5 years. It raises its dividend by 10+% year over year. And I'm just like, what's different? Like, there's got to be something wrong with it, right? I don't hear anybody I hear about, everybody talks about realty income. I never hear anything about ABR ever. And I think one of the things is me and one of my friends, Chad, were talking about this the other day. Because it's a mortgage REIT, it keeps coming up as a financials sector instead of a real estate sector. So maybe people are put off by the payout ratio, but it's still a REIT. So like it still has to have the high payout ratio, but it's a mortgage REIT, so it comes up under financials and not REIT. So like I wonder if that's like part of the problem with like why more people don't talk about it. Because I know a lot of people, you know, all these little fancy graphics you see on the internet and stuff, it's like, oh, if the payout ratio is above 60%, stay away from it. And if they see, except for REITs, but then they look this one up and they're like, oh, it's a financial, it's not a REIT, and that kind of thing. So
I would have to look. I remember now that I'm looking at it, I've looked at this before, and for some reason I've passed on it.
yeah.
And
Yeah.
I don't know why.
Like I said, it's not often you find over a 10% yield with over a 10% dividend growth rate. Like that never happens. So that's really that. Like I said, every time it has the opportunity to come up on one of my lists, it does. And it's not like, oh, me picking it because everybody likes high yields kind of thing. It's like, oh, okay, like this one meets my criteria, and here it is. Like it's a rare situation. And then on Friday's video that I just released, CSWC is another one. Capital Southwest.
Yeah.
That one, I don't know if that is I know it's in the financial sector, but I don't know if that's also a mortgage REIT. Same thing, high yield, high dividend growth rate, outperforms the market. And it's just one of those, I never hear anybody talk about Capital Southwest.
I've not ever looked at that one.
Yeah, so there you go. So, hey, what I'm learning is every Friday at 8 o'clock our time, these videos come out with my top 5 stocks. It'll take you. I mean, you have all your filters, which is the best person to look this through. Because like my idea is just to expose you to the stocks. You do with that information what you want. I'm not telling you to buy all these, but it's a fresh list of 5 stocks every week, and you get to be like, oh, okay, I've never heard of that one. Like, let me add it to the list and see if I can find something. Or like, I've already looked at that one. It's not for me. Whatever. But like, that's a really good series. Videos are typically under 8 minutes long, and you can check that out
on your channel.
Yep. Dividend Recession every Friday, 8 o'clock.
Yeah, I'll check that out. I use resources like that to there's a lot of stocks out there know, that I might not have heard of. So the Facebook group we're in, most of them, doesn't mean I'm right, but it's just it doesn't fit my style. But I'll use it. I'll go, oh, okay, let me go check this out. Or somebody will put such and such dropped. And I'm like, well, maybe I've missed this. And I'll go, no.
Yeah, there's a reason. Yeah, there's a reason.
My thing, you know?
Yeah.
But, and I, there's a lot of stuff I've passed on that went through the roof.
Yeah. I mean, like I said, the idea of the series, like I as of like 2 or 3 weeks ago, I called it my Power 5. And the idea behind that was like to give you a leader in the dividend yield, dividend growth rate, dividend streak, 10-year returns, and the percentage off of the 52-week high. Those were the 5 categories. And I didn't get tired of it, but like I went back and looked at some of my old videos and I used to do my top 5, and it was just 5 stocks that I liked. And the idea is that you're not going to like all the stocks I like, but here's a list of stocks that I like that you might not have considered because we have different styles, but they might also fit your style kind of thing. So, and like I said, it's super quick. Videos are under 8 minutes. You can watch those videos every Friday. And like I said, take away, write down the 5 tickers, go do your own research. If they fit, they fit. If they fit, but not right now, then put them on your watch list kind of thing. Set your
I do that. So I'll check that out.
Yeah.
I'll that's one way that I find stocks. Like I say, the Facebook group. Another way I'll do it, like I recently mentioned, I've been looking at small cap stocks, and a lot of ways I'll find names. I'll go to the big fund managers and I'll go, well, what are they holding?
Yeah.
I'll go find a small cap fund, maybe from a guy that I maybe share the same philosophy with, and go, well, what's he found? Top 10. So I'll look at the top 10 and how does it fit my philosophy?
Yeah.
And I'll just whittle them down.
Yep. And that's this, like I said, the important thing, and like for everybody else watching, and especially for you, is like you have your criteria. So it's not like, oh, I'm just going to blindly trust Troy on Facebook or on YouTube. Like that's never a good idea. And obviously not financial advice, whatever. But like the idea is that you have my videos as a resource, and then you can grab that information, and then you can be like, okay, I'm going to plug that into my stuff and see if it works. So I think that'll fit perfect for you, because like you have all the stuff that you look for, and like I said, most of them could be trash and most of them could be great, and you're like, hey, this is the greatest resource I've ever found. So hey, whatever you find, leave a comment on it and let me know. Like I always like the comments on the video, like, hey, somebody, Mark, I actually interviewed him, I don't know, a bunch of months ago. He bought Comfort Systems USA. It's stock ticker f.i.r.e, and he said that he's up over 50%, and he bought it in December.
I was just looking at that, actually.
Yeah, that thing kills.
Looking at that. That's one that I was looking at.
And then the one of the, so not to spoil the whole video, like I said, it was just released yesterday, so you can go on the channel and watch it. But one of the ones that I mentioned in this week's video was Lamb Research, LRCX. That thing's a
Mm-hmm.
tank.
Yeah.
That thing doesn't miss. That thing, Lind, which is the air condition company,
Mm-hmm.
that thing, that they have a monopoly on the system. Like that, if you have a Lind system, you need to replace it with a Lind system. Like that's how much they have. Like your duct work and everything is connected to how they do things. It's crazy how they do it. But yeah. Anyway, so yeah, enough plugs for my Power Five or my top five series. But
That's cool. I'll check that
yeah,
out.
go check that out. Let me know what you think. So, okay, so we talked about this before with your diversification. One, I want to ask is how important is staying diversified. Two things I want to ask is, what does over diversification look like to you? And the third thing, so hopefully you can remember all these. Third thing is, do you value the diversification of not only your stocks and your sectors, but where you get your income? Because I feel like that is one of the diversification methods that people don't seem to think about. Is they're like, okay, I have my portfolio, it does this, but because of yields and all kinds of different stuff, they might get 20% of their dividend income from their portfolio from one holding. And I'm like, that's probably not a good idea, especially as you get later in life where you start to like get closer to needing that. If they do a cut, you're screwed.
Yeah, I would be concerned with that. I I think you can be over diversified. Um, I mean, the way I do it anyway.
Are you speaking this from experience or just in general?
Just from my own experience, no, I have a 401k, and I try to structure it different than my individual stock holdings. Are mostly value stuff. Um, so probably I'm probably way more diversified than I even realized. But
Well, where I see it a lot of times is like the people that are like, and this is an extreme example, but they'll buy VOO and SPY. And I'm just like, first of all, those are the same thing. And then second of all, like you
yeah,
don't like some people have like 13 ETFs, and it's not like sector ETFs either. It's like broad market ETFs. And I'm like, what are you doing? I'm
right,
like, you have exposure to 4,000 holdings. I'm like, you don't need
right.
that.
Well, I try to do, I, and I think over time I've gotten even more picky about what I buy. So I think I naturally my diversification has gotten smaller and smaller because of that. Um, and I guess what I mean is, hopefully I explained this right. Go back to the financials. To me, I shouldn't find if I do my research right, I shouldn't find a dozen financials to buy.
Mm,
I should find two, maybe three,
yep.
and that's kind of where I'm at. J.P. Morgan, it's my largest position in financials. I think for obvious reasons, and I think I only have two other positions in the financial sector right now. Um, that's what I mean by I think in my way of doing things, I could become over diversified. I'm probably the more I do this, the less diversified I am, as far as just a bunch of different names. In other words, I try to stay diverse in I don't want to have most of my money in REITs. So sector wise, maybe that's where my diversity is. But name wise, when you drill down into those sectors, that's where I'm not very diversified. Like
Mm.
I only own, off the top of my head, three REITs, three financials, healthcare, maybe even worse. Trying to think off the top of my head, I could be wrong. I'd have to look a little harder, but I think healthcare wise, right now, all I have is Johnson and Johnson.
I think I only have AbbVie.
Do you?
Yeah.
Yeah. So as far as healthcare goes, I'm not very diversified at all.
Are there any sectors that you don't have or you like just don't just flat out don't like? Because I have some.
Well, like I said, I'm not a huge utilities fan. Um,
I think Next Era Energy just ruined that for you. I think that's what happened. You're like,
it's
screw utilities.
yeah. When I was doing my research a couple weeks ago, trying to find utilities, it was the one that kept popping up for me.
Yeah.
It's the one I kept liking. I'm like, huh?
I like to hear it, but I want to see it also. Like that's
I
that'd be
agree.
nice.
I agree, and I own it. But I'm like, it kept popping up, and I'm like, but I don't want to buy it anymore.
Yeah.
So, and even from a value point, it's like it's there. It's there, and I
Yeah.
should really probably buy more of it. I'm probably going to end up buying more of it
Yeah.
because they
Good.
keep
Good. Yeah. Drive that price
popping.
up so I'm not as so in the negative.
What sectors do you not like?
I don't like communications.
Okay.
I think I just don't. So I think the only two sectors I don't own in my taxable account are communications and real estate. Where real estate makes sense, it's not tax advantage kind of stuff like that. But yeah, there's been a couple communications that have like been kind of interesting, like Nexstar Media Group. I kind of like NXST, I believe. It's so weird. I don't realize that I know as many stock tickers as I do. That's kind of impressive. But so yeah, Nexstar Media Group. I did a versus series. If you ever want a good laugh, watch my newest video, the one I told you about that I just released on Friday. Go back. I have a playlist on my channel called the Versus series, where everybody always does like Home Depot and Lowe's, like which one's better kind of thing.
Right.
I started with that, but I get curious. Like I'm the rabbit hole type of guy, and I'm always like, well, what's this best stock in every sector? Like screw Home Depot and Lowe's. Like yeah, they're direct competitors. Which one's better? That's cool. But like, what's the best technology stock? So I shouldn't have done this because it took literally countless hours, countless days, countless weeks to do this research. But I literally did like a March Madness style bracket
Oh, cool.
on all the stuff, and I went through and I was like, okay, what we're gonna do is we're gonna start by the smallest market cap to the second smallest market cap, and we're just gonna go down. And I have certain criteria that I wanted them to meet. Whichever one met the most of those criteria, that one would move on and versus the next smallest market or next biggest market cap, I should say. And it went up. And the annoying thing was like sometimes you'd get the cool response where it's like, oh, okay, this one that's like the 87th largest market cap in the sector ended up winning. Like it has all the best numbers. And then sometimes it was just like, hey, do 800 companies worth of research just to find out that JP Morgan is the best one. And I'm like, well, that's the biggest market cap. That's kind of annoying. So like that was financials. Financials was awful because there's so many bank stocks. So I went through all these little banks, little regional banks, all this stuff just to find out this little bank was versing JP Morgan and JP Morgan had better members. I was like, well, I could have just literally did the last two teams and found that response. But I wanted to do my due diligence, do the whole thing. But
that's cool.
that was a really cool series as far as like informational out of it. I would never do it again because the amount of research and time that took was not fun. I mean, if I was like full-time YouTube, I'd consider it. But yeah, if you want to watch those, one, I'd be curious whatever the best stock was when I identified it, if it was still considered to be the best stock kind of thing, like today. And then two, if you want to laugh, look at how bad the edits were. Like some of the videos, I'm just like standing up, like just against the wall, like just talk. It's bad. So,
Cool.
But yeah, that stuff's fun.
Yeah, I don't have a lot.
Do you own any communications?
I have. Well,
you're not an AT&T guy, are you?
That's my biggest no.
I was like, you can't. I feel like value investor and AT&T don't work together. Like I don't.
That's definite.
Yeah. I mean, hey, we did say catching falling knives, and you have a. I don't know what you'd be catching it with anymore because you don't have any hands left. But yeah.
I was just looking. I don't agree with this, but this thing I'm looking at has Google as a communications. I guess technically, they have YouTube and.
Well, yeah, but I feel like that's a tech stock.
Me too.
Yeah. Well, they do the same thing with like Visa. Like Visa's considered a financials. That's one I own.
Yeah.
And like kinda, but it's also like a tech stock.
Google's one. It's not a dividend stock, but that's. I think it's at a pretty good price right now. I've been nibbling at Google.
Yeah.
So.
I feel like that's cheating. But yeah, okay. So in that case, I feel like Google's a good communication stock. But yeah, when you talk about like dividend paying, everybody is under consensus. Like your cell phone companies. Yeah, Comcast is okay, I guess. But like like you said, I feel like there's so many other opportunities. Like to me, that's another thing when we're on the topic of diversification. I think a lot of people try to fit these molds of I have to buy a stock in this sector because I'm underweighted or I don't have anything, when there could be something that's a slightly less attractive opportunity, but it's a significantly better company.
Yeah. No, I don't. I don't do. I don't worry about that too much. Like I said, I'll go. I'll even go overweight in a sector if the value's there.
Yeah.
If there's good value, and just because of that, because I'm buying in that sector, hypothetically I'm not there, but right now real estate, I could see me going over. Like you say, 25% is what they say. You shouldn't have more than 25%, 25%. I wouldn't be worried if I was 35% at the time.
Yeah.
Because I know over time that's gonna, whether it's because I've trimmed back or because another sector become, uh, you know, in my range, I'm starting to buy. Maybe it's healthcare. Maybe healthcare gets smashed, and I start buying a bunch of healthcare stocks, and eventually it's real estate shrinks, even if I don't do anything to it. Healthcare, so it ebbs and flows.
Yeah. Yeah. Okay, and then so this is off topic, but you did bring it up a little bit. What would you say? Because I've said this a bunch of times in other interviews too. The value of having like the good filters and criterias that you select, and also the value in understanding that you do have to tweak your. If you like, I'm all over the place here, but there's a website I use called Dividend. It's called Portfolio Insights, and I get the dividend radar off of that, which is the CCC list, your champions, challengers, and contenders. All stocks that have paid and grown their dividend for 5 or more years. So it's like a supercharged kings and aristocrats list. I get that for free every day or every Friday on that website. I see a lot of people that'll use something like that. They apply their filters, and when they get done applying their filters, they end up with 85 stocks to look at. And like, so the question to you is like, what do you say to somebody like that? Or what advice do you give to somebody about like, hey, if you're doing filters, a good filter, you should have less than a handful of stocks to research. Like, in my opinion, that's how it should work.
I agree with you.
Because like so many people are trying to get like this big basket into a slightly smaller basket. And I'm like, that's not how like you shouldn't be overwhelmed with your results. Like it should be like, hey, here's a couple to look at.
I agree with you, and I'll do that with filters. And if I find that I've just got 2 pages of stocks, I know I've done something wrong. Yeah. I'm like, man, I've got to get in there and adjust this. Cause
you go in and you're like, okay, instead of an 8% dividend growth rate, what about an 8.5% dividend grroth rate? Like try to get rid of some of them.
Yeah.
Yeah. Okay.
Back to being a lazy investor too.
I mean, I've talked about this ad nauseum, but like I sold NVIDIA. Of course, hindsight, shouldn't have probably done that, but it didn't meet one of my criteria. So I was like, okay, whatever. So I took the capital. I was up 55% on it, so it's not like I lost, but I was up 55%, sold it, rebalanced the portfolio, and also added a new position, which was Costco, which is my best performing position. At the time, it was considered overvalued. It was $4.94 a share, and now we know it's not $4.94 a share. It's worth a lot more than that, like over what, $7.60, something like that, $7.20. I know it just dropped, but it's expensive. But anyway, so I did that. And when I was filtering for the next stock to buy, like Costco was in my mind of like what I wanted because I've heard a lot of things about it. But I did my filters. When I got done doing my filters, there were 2 stocks on the list. Now, mind you, that CCC list has over 700 stocks on it. So I was able to add filters to narrow it down to 2, and then I just did research on 2 stocks. Which one do I like more? And then I bought Costco. So I feel like that is an undervalued part of not just dividend investing, but investing specific in general. It's just like you have to. It's important to have criteria, but also don't be like scared to tighten up the criteria because like there might be a time where you have certain criteria and nothing meets it. That's when you hold cash.
Yep.
Or you add to the current positions that you already have, and you're not adding anything new because you don't have any good opportunities.
We're on the same page. I 100% agree.
Yeah. Okay. So last question for you. It is still whatever day it is. It's March 9th, so obviously the market's closed. So market opens on March 11th, something like that. It's March 11th. Market's open. You are now 18 years old in today's market. You know everything you know today, so you can't be like, oh, I would go buy it back and buy NVIDIA. Like you can't do that. It's today's prices. but you just have all the knowledge, but you're 18 years old. What do you do? What do you tell yourself? What do you do different? All that kind of stuff.
Come again? Ask me.
Okay, so it's today's environment. Everything's the same. Only thing that's different is you're 18 years old. You still know everything you know that like you know today. It's just we're not going back in time to like buy stocks when they're $10 and now they're $500. Like we're not doing that. So it's today's prices, today's market conditions, today's rates. Everything's the same. You're just 18. What do you do different? What advice do you give your younger self? What advice do you give maybe an 18-year-old that's watching today? Like what do you give?
If I was 18, I probably wouldn't be as much of a stickler on the value. In other words, like now, 50, I'm more apt to not pay what I consider a high price for a stock. And I know I'll miss out on some stuff because of that. But at 18, you have the advantage of time on your side. So just like what you said with Costco, you can afford to pay a little more for a really, first off though, I would tell myself, learn, if you're going to buy individual stocks, learn all you can about what makes a good company, growing revenue, good margins, high profit, all that stuff, low debt, find those good companies. Don't just gamble, but say if you can find a Costco or a Nvidia, and I wouldn't chase Nvidia right now, but I wouldn't be. I'm just trying to go. I'm rambling a little bit. I'm trying because that's a tough question for me.
Yeah.
But I wouldn't be as concerned with it being 18 about value. I would be more willing to pay what I would consider a higher price for a stock at 18 than I am at 50. I would be way less concerned about the dividend yield. I would not chase high yields. I would be way more concerned with dividend growth. If they're dividend payers, I wouldn't limit myself to dividend stocks either. If I was 18, I'm not saying stay away from them, but find. Don't worry about the yield. If it's paying a 0.5% yield, but it's growing at 20%, and it's a great company, don't worry about the yield.
Yeah. How do we make it cool to, how everybody always posts like what's their dividend yield of their portfolio and stuff like that? How do we make it cool where we tell people like, make it cool to have a high dividend growth rate? How do we do that?
I don't know. That should be it, or like yield on cost would be another good one.
Well, I feel like the yield on cost. So I actually interviewed a couple people that they don't believe in yield on cost. They don't think that's a thing. Which is it's always compelling. Like I've actually interviewed somebody that they said they don't believe in diversification. They buy what they know. And why would they spread themselves thin when they know this thing's going to do well? And I'm like, I mean, it's risky, but it's worked well for them. So to teach their own. So like I feel like with the yield on cost, other than people not believing in it, the thing that is like people will say that they have a higher yield on cost because they bought something that already yielded 8.6%. So the yield on cost thing, they could still manipulate that. Oh, my yield on cost is 13. I'm like, well, yeah, but you also bought a stock with a 13%. So
that's true.
If there was a way as a dividend investing community that we could get the focus off of yield in general, especially when you're younger, if off of yield in general, make it cool to brag about your dividend growth rate as a whole, your portfolio. Like, what's your dividend growth rate? Oh, 12%. Mine's 14%.
Yeah, I agree. I have to refrain myself on the Facebook group we're in sometimes, and I just let it go. But everybody has their own way. But I see a lot of people just jumping in, and I mean, money is you work hard for it. You should not just. And right now, you get paid 5% just for sitting in cash.
Yeah.
Put it in cash and be patient. Learn. And if looking at individual stocks is not your thing, if you don't like doing the research, if you don't enjoy it, don't do it. Buy a index fund.
Yeah.
Dollar cost an index fund. Don't worry about it.
Yeah. That's my, not financial advice kind of thing is I always say that, like, if you have no interest in the stock market, you don't give 3 Fs. Like literally take something out of every paycheck, something every month. I prefer paycheck just because it's more frequent and it's like you don't have to make sure you set aside $500 a month. Like it's $250 a paycheck kind of thing. But yeah, $250 a paycheck, $500 a month, whatever. Put it in the S&P 500 and just go about your business. Do that for 30, 40 years. You'll appreciate this conversation.
You'll be fine if you're not a nerd about it like we are, and you don't enjoy, because it can be. I get it can be boring.
Yeah.
Don't do it. It's not your thing. If you don't have a passion for it, you're probably gonna cost yourself money.
Yeah.
You're gonna lose money because you're gonna freak out. You're not gonna have your own system that you're confident in. You're gonna see the next guy that pops up on YouTube telling you to sell what you bought, and you don't know what it's worth, so you're gonna knee jerk and sell it.
Yep.
I think a lot. I see a lot of that, and I kind of feel bad for them. And there's a lot of people on there that. Like you and I, we may not agree. You're not a value guy. I am, but doesn't mean you're wrong. We're looking at from different time frames too. But the guys, even though we don't agree, I can tell they have done their research. We may not agree. I don't know their name. I can't remember. There's a few guys on there that I don't may necessarily agree with, but I can tell they know their stuff. They do their research. Yeah. So when I see them post something, I'm more apt to go, I'm going to go check that out. I know that guy's looked into it. And some of the guys I like to kind of argue back and forth about, it's like, no, Medtronics is crap.
Yeah. Even if you own, like, it's your biggest holding, you're just like, I hate that stock. Like it's, just to see what they say. I mean, that's what they like, not to ramble on about this, but like, that's one of the things that they say makes a successful investor is if you can look at the negatives of the companies you own and then support the positive against that kind of thing. Like, okay, I know that this is a detriment. Like for NextEra Energy, that's kind of what I did. Like I was like, hey, NextEra Energy does have a lot of debt. Here's what they're doing with their debt. Here's why they have a lot of debt. Here's other positive things about this company and why I think that outweighs the negatives. So, and like I said, I don't know if you can hear that freaking, in Oklahoma, you're probably familiar with this. At noon, they test the fire alarms or the
just went off.
Sirens. So, hey, they're tested. They're good. So for the next 3 minutes,
it just went off.
I can't hear yours. So as long as you can't hear mine, we're good. But
I heard mine. I didn't hear yours.
Yeah. So there we go. So our good news is for everybody concerned, our tornado sirens are working fine. So so that's one of the things is like they always say that to like really. Like, don't ignore the negative things about the companies that you own or the companies that you're interested in, but find if you can acknowledge and find all the bad things, but then still find positive things you're not going to find a perfect company. Like literally Apple is the most valuable company in the world and people are poo-pooing on it right now.
No, I do what you're saying too. I like that because you're automatically going to try to justify, what you're looking at. You're going to go, like ADP, man, that's a great stock. And then
you get your own little like echo chamber and nothing else gets in it.
And so I try to intentionally do what you just say. I will go up, whether it's on Facebook, I'll see some guys that I like on that group. And if they don't like something that I like, I'll put some weight into that. I'm like, okay, let me go check that out. I know this guy that does his homework. What's he seeing that I'm not seeing? Or I'll go to look at different research. Like Morningstar has a thing. If you go to Morningstar, it'll give the bull case and the bear case. Mm-hmm. And I always try to look at that bear case really hard. I just almost look over the bull case because I'm already making the bull case.
Yeah.
I try to go to Zacks does the same thing. Zacks has a thing on their research that you'll turn to and say why you should not invest in this.
Well, that's a really good, like you said before, there's thousands of companies out there. There's a limited amount of money that you have, unless you got some kind of well that I don't know about, but you have a limited amount of money to invest. So like the idea is that you want to identify good companies and you want research to convince you why you shouldn't buy that company. And that's what you're looking for, whether it's Facebook groups, whether it's, the bear cases on different websites or whatever. Like, hey, I'm about to put money into this. Convince me why I shouldn't.
Yep, exactly.
So
Exactly.
I like that a lot. Well, Dick, it's been a pleasure to speak with you today. I had more. I told you an hour goes by real quick, so we're at an hour and a half. So, but yeah, it's been a pleasure speaking with you today. I know you said you don't have anything to plug, but if you have any final words to say before we sign off, the floor is yours.
No, I don't have anything to plug. I'm pretty boring. I set up here in rural Kansas and try to shut out the world and do my own thing. So I appreciate the invitation to talk investments with you. Like I said, it's kind of a passion of mine, and you don't get to talk to a lot of people about it. So
Yeah.
I don't do YouTube, so hopefully the setup's okay with you.
Yeah, you're good, man.
But thank you.
Yeah, no problem, man.
I had a good time. It was a good conversation.
And that's going to wrap up this week's discussion. I really hope you enjoyed my conversation with today's guest, and thank you for spending part of your day with us. Remember, if you want to be on your very own episode of Dividend Discussion, make sure you reach out via email at dividendobsession@gmail.com, and I'll be in touch. But until next time, see you.